Equity investors make investment decisions based on the expected return from equity investments relative to the risk of realizing those returns. Similarly, lenders make lending decisions based on the expected return in the form of interest revenue relative to the risk of borrowers defaulting on the repayments. Hence, the analysis of risk is central to any decision to commit economic resources to a project or an investment. Most of the risks faced by any firm are inevitable, and the firms must continually monitor the risk faced to ensure that appropriate actions are taken to minimize the impact of detrimental events or changes in circumstances. The focus in this video is on how to assess the financial consequences of the various types of risks faced by a firm using disclosures and data from the financial reports. Financial flexibility is the ability of a firm to obtain debt financing conditional on its current leverage and profitability of its operating assets. The disaggregation of ROCE provides insight about the degree to which common shareholders benefit from using leverage. While high leverage generally increases ROCE, it also increases the overall risk of a firm. This risk is primarily attributable to the increased interest expense and the requirement to make interest and principal payments in cash when they come due. The following alternate disaggregation of ROCE provides insights on measuring financial flexibility. Operating ROA is the rate of return the firm generates on its net operating assets. It is different from the definition of ROA discussed in previous video, primarily because the denominator is net operating asset as opposed to total assets. Leverage is the ratio of total financial obligations and common equity. Spread is the difference between operating ROA and the net borrowing rate. The greater the spread between the firm's operating ROA and the net borrowing rate, the more beneficial incremental borrowing will be for firm's common shareholders. For example, if a firm's operating ROA is 10%, debt to equity ratio or leverage is 9, which basically means that the firm's debt is 9 times that of equity, and cost of borrowing is 5%, firm's ROCE is given by 10% plus 9 times 5% or 55%. Increase in debt likely increases the cost of borrowing, which should result in lower spread. The ROCE of the firm in this example will continue to benefit from increasing debt as long as the cost of borrowing is less than the operating ROA or as long as the spread is positive. This alternate disaggregation of ROCE is useful in understanding that the situation for ROCE to be less than ROA is when the spread is negative. Short-term liquidity risk is the near-term ability to generate cash to meet working capital needs and debt service requirements. If a firm can delay all its cash outflows to suppliers, employees, and others until it receives cash from customers, and the firm receives more cash than it must distribute, the firm will not likely encounter any short-term liquidity problems. However, most of the firms cannot really time their cash inflows and outflows. As an extreme example, consider a single malt Scotch whiskey distillery that incurs significant cash outflows for grain and other ingredients, distills the whiskey, and then ages it in wooden barrels for many years before finally generating cash inflows from sales to customers. Additionally, long-term leverage can trigger short-term liquidity problems. For example, a firm may assume a relatively high percentage of long-term debt in its capital structure. This level of debt usually requires periodic interest payments and may also require repayment of principal in cash. The operating cycle must generate sufficient cash not only to supply operating working capital needs, but also to service the debt. Our text discusses 6 financial statement ratios for assessing the short-term liquidity risk. These ratios are current ratio, quick ratio, operating cash flow to current liabilities ratio, accounts receivable turnover, inventory turnover, and accounts payable turnover ratios. Please review the text for further details on these ratios. The last 3 ratios can be used to calculate cash conversion cycle. Number of days in a year, or 365, divided by accounts receivable turnover ratio gives us the number of days account receivable outstanding. Similarly, 365 divided by inventory turnover ratio gives us days inventory held, and 365 divided by accounts payable turnover ratio gives us the days account payable outstanding. The number of days firms hold inventory until sale plus the number of days firms hold accounts receivable until collection indicates the total number of days from production or purchase of inventory until collection of cash from the sale of inventory to customers. This combined number of days indicate the length of time for which the firm must obtain financing for its primary working capital assets. The number of days accounts payable are outstanding indicates the working capital financing the firm obtained from suppliers. The difference between the total number of days for which the firm requires financing for its working capital and the number of days for which it obtains financing from suppliers indicates the additional days for which it must obtain financing. This difference is known as cash-to-cash cycle or cash operating cycle. It's also known as cash conversion cycle. And it quantifies the length of time between cash outlays that ultimately results in cash collection. Long-term solvency risk is the longer-term ability of a firm to generate cash internally or externally to satisfy planned capacity and debt repayment needs. Profitable firms generate sufficient cash from operations but are also able to obtain needed cash from creditors and equity investors. Therefore, the measure of profitability such as ROA and ROCE are useful in assessing the long-term solvency risk. Additionally, analysis of long-term solvency risk must begin with assessment of the level of and the trends in financial flexibility and with an analysis of short-term liquidity risk already discussed prior in this video. Three common measures for examining long-term solvency risk are debt ratios such as debt-to-equity ratio, interest coverage ratios, and operating cash flow to liability ratios. Again, please review the text for further details on each of these ratios. You will need to calculate these and other ratios for your final project. Bankruptcy risk relates to the likelihood that a firm will ultimately be forced to file for bankruptcy and perhaps subsequently liquidate due to a combination of insufficient profitability and cash flows and high debt service costs. The most widely used bankruptcy prediction model is Altman's Z-score, which is the weighted sum of 5 different ratios. Each ratio captures a different dimension of profitability or risk. Net working capital to total assets ratio serve as a measure of short-term liquidity risk. Retained earning to total asset ratio accounts for past profitability and relative age of a firm. Earnings before interest and taxes to total assets ratio measures current profitability, which also has the highest weight. Market value of equity to book value of liabilities ratio measures long-term solvency risk. Sales to total asset ratio indicates the ability of a firm to use assets to generate sales. Z-scores of less than 1.81 indicate a high probability of bankruptcy, while Z-scores higher than 3 indicate a lower probability of bankruptcy. Scores between 1.81 and 3 are in the gray area. The last type of risk I want to cover in this video is the market equity risk, which is measured by beta. Beta is a measure of systemic or undiversifiable risk of a firm. The market, through the pricing of the firm's shares, rewards shareholders for bearing systematic risk. By constructing a diversified portfolio of securities, the investor can eliminate the effects of unsystematic risk on the returns to the portfolio as a whole. Thus, market pricing should provide no returns for the assumption of non-systematic risk. However, several firm-specific risk factors are intuitively related to firms' market beta. These factors include operating leverage, which refers to the extent of fixed operating cost in the cost structure. For example, CMU with its investment in buildings and full-time faculty members have relatively high operating leverage. CMU can reduce the fixed cost by renting the buildings or hiring temporary faculty and staff. The second factor, financial leverage, relates to the proportion of debt in the capital structure. The higher the proportion of debt financing, the higher is the fixed cost for interest and higher is the risk. The third factor, variability in sales, captures the firm dependency on economic condition. For example, the Halloween store in town that depends heavily on the revenue generated during a specific time period in a year may not survive during the bad economic condition. The last factor that impacts the market equity risk or beta is the stage of the firm life cycle. For example, a startup pharmaceutical firm is more risky than a matured pharma company such as Pfizer. In this video, we talked about 5 different types of risk faced by the firms. Please review the text for further details on each of these risks and other risks that are not covered in this video. For your final project, I would expect you to calculate the various profitability measures such as EPS, ROA, and ROCE and their components, and assess the 5 risks discussed in this video for your firm and the competing firm for the past 5 years. Analyze the trend in each of these ratios. Now, if you have access to our trading lab, you can download all of these ratios from the Bloomberg terminals.